European financial markets are ticking a little higher this morning with the UK's FTSE 100 index up around about 3 points, while the US 50 index is higher by just about 5 points. It is very range bound, so it's just very tentative gains at the moment. When it comes to the commodity space, gold is up around about $5 after having a pretty good day yesterday. Oil prices continue to ease, and in the currency space, the dollar is the standout winner, of course, versus its rivals in the bond market space. Peripheral bonds are behaving themselves, core government bonds are falling out of favour, so UK gilts and German bonds are slipping somewhat. Good morning, I'm Ishaq, Siddiqi, and welcome to your daily market plan. I'll give you a quick idea of what's going on in financial markets today. We'll go through the overnight session in the US. It was weak, 5th consecutive day of losses for the S&P 500 index, putting a bit of pressure on in the Asian market. Asian markets actually showed pretty good character, a little higher across Asia, very tentative gains, nothing to really inspire us here in Europe this morning. So we started off the session on a firmer note and really looking for some direction going forward through the session, and we've got some key data releases that may provide that for us, particularly US GDP figures for the final GDP figure out for the second quarter this afternoon, but before that we have, of course, the UK GDP figure for the second quarter. Now, back to what's really driving price action at the moment is this fiscal situation in the US, the possibilities of a government shutdown if lawmakers in the US can't agree on a way to formulate a new budget which will raise the debt ceiling. The US Treasury is running out of money, or run out of money by October 17th, something about 2 to 3 weeks essentially, let's say 3 weeks now, to figure out a way to find a fresh budget. Now, the Republicans and the Democrats are polar ends on this. They find it very difficult to agree with each other. There's no give between both parties, and we see time and time again in US Congress that this seems to be the case. So there's a possibility that they may just kick the can down the road like they've done for the last 2 years. They've done it since 2011. There's a possibility that they'll do it again. But this time around, it has been more imperative that they actually sort this out. So the investors are really hopeful that we may get some sort of constructive talks by US lawmakers to agree on something, but at the same time, it seems pretty hard fought. Now, getting into what that means for monetary policy, the Federal Reserve is likely to hold back from tapering until the situation clears up. It's one thing that they said last week at their policy meeting, which is why we didn't see tapering on board, or one of the reasons why we didn't see tapering. Today, with the US GDP figure out for the second quarter, it's likely to come in around about 2.6%, so an upward revision from about 2.5%. That'll be the final reading. Now, if we do get a pretty strong number, that's going to put pressure on those 10-year Treasury yields. If the 10-year Treasury actually pushes above the current level, it's at 2.6% right now. If it goes above that, we may start seeing a bit more worries in the market. And we have to remember that the rising interest rates in the money markets is one of the reasons that banking held back from tapering quantitative easing. So there's no real win-win situation for the market. We won't be able to second guess the Fed anymore. A good GDP number is going to suggest that the US recovery is in play, but also raise interest rates or long-term interest rates, and that's going to hold the Fed back from tapering. If we see a weak number, of course, that is going to help push the Fed back from tapering as well. So when it comes to tapering, we don't really know what's going to happen, when it's going to happen. There's a possibility that they may start tapering in December, and that's because the Bernanke is on his way out, and somebody needs to get that ball rolling. Now, on the UK GDP side, the figure has been strong. It was confirmed at 0.7% last month in the second release. The final release is supposed to be, it's going to be coming around about 0.7% as well. It's going to be a confirmation that things are going well in the UK, that we are on a path of recovery. But the Bank of England still remains pretty dovish and bearish on the whole on the UK's growth prospects. The market is very much unconvinced by the forward guidance plan. And we got this, the 10-year gilt yield at the moment is pricing on a rate hike in 2015. We know that the Bank of England's threshold for a rate hike is somewhere around late 2016, so a year out basically, and that basically means that the market is undermining the Bank of England at the moment. So those are two things to look out for today. We also have weekly jobless comes out from the US that should shed more light on the labour situation in the US. US. Other than that, there's really not much else to say. It's going to be pretty subdued across the board. There's not really anything too big on the corporate side driving the market. We know that Royal Mail has just kind of used that the IPO is going to be around about $6.9 billion. So a bit more information on that. On the corporate side, H&M came out with numbers which are better than expected. Operating margin was much better, gross margins as well. Profit came in better than expected. They continued expansion plans. They just launched in the US online market, which is very strong for them. At the same time, they see China as their biggest area of expansion. That is all for your daily market bite. Tune in for another one tomorrow. Cheers for watching, people. Bye.